What's up, y'all? Welcome back to the Mining Pod News Roundup edition. We've got a full panel today with Colin Harper, your boy, Matt Kimmel, and Khan Ferrani from Luxor, our guest this week, and a research associate at our friends Luxor and Hashrate Index. He covers a lot of mining data, so he will be a fabulous addition to today's show. We've got a packed schedule. Khan is going to be going over a newsletter he wrote for us this week on Bitcoin mining data 1 year after the halving. Before that, we will be looking at Tether expanding its tendrils into the Bitcoin mining industry as it eyes a $25 million stake in the upcoming Ant Alpha IPO. We'll hop over to an update on Galaxy's CoreWeave deal. We've got some data from Cambridge's latest report on Bitcoin mining's energy usage and renewables penetration. More than you think, but maybe not as much as you would hope, depending on where you stand. And then we will be covering the op return drama on Twitter and GitHub this week for those who have not been tuning in. Certain people want to expand Bitcoin's op return limit. Others don't want to. We don't know who's going to win, but we will cover all of the salt and tears for this week's Cry Corner. And as we record this, Bitcoin is surging. It's knocking on heaven's door at 97,000. Looking at 100K, we might have it this week. Good times, and maybe we're out of the doldrums, but we'll have to see. Today's show is brought to you by Fractal Bitcoin, but we'll learn more about them later in the show. For now, let's get right into it. And we're back. Difficulty weatherman Matt Kimmel. What are we seeing in the forecast for Bitcoin's difficulty and network data?
Yeah, Colin, we are 83% of the way through the epoch here, and we're looking at a dramatic difficulty adjustment decrease. I was looking before the show, and we have had an absolute streak of, I think, 13 of the last 15 difficulty adjustments have been increases. Just a brutal ripping setup for miners, where hash rate is just, kind of over the long run of the last couple months has been absolutely ripping. On a hash price standpoint, the transaction fee market pretty dry. We are in a kind of stable to rising price environment right now. As you mentioned, we're coming up on 97K, and hash price from that's dollar per petahash second per day, the metric kind of measuring broader miner revenues on the network. Looks like it was really sort of defended a bottom that's been pretty consistent over time of about $40 per petahash per day, and is rising up now, looking like it's about a touch 50, and that would be the highest mark we've seen since, what is that? I guess we touched it at the end of March, but rejected it pretty strongly. We really have to go back to February before we were really stable above those levels. And it's all but certain we're going to, eclipse that with this looming difficulty decrease.
Yeah, so if Bitcoin's price holds over the next few days as we see this downward adjustment come to fruition, then we'll definitely get above $50 per petahash per day. And like you said, Matt, we haven't seen that in over a month. And hash price with this current Bitcoin rally has recovered about 25% from a local bottom of $39 per petahash per day, which is slim pickings. So just above 50 might not seem very good. A few years ago, that would have been harrowing for a lot of miners, but they're eating good with that right now. And I think the missing part of this conversation, as we hop over to network hash rate, brought to you by Hashrate Index and Luxor. That's where we get all of our data from the Mining Pod. One of the most interesting things over the last few months in the Bitcoin mining realm is like 100 exahashes have just disappeared from the Bitcoin network. And it's not really clear why that's happening. I don't know if this is seasonality, if miners are just coming offline because economics have been brutal. But as you can see from this chart, if you're on video, on April 8th, Bitcoin 7-day hash rate average hit an all-time high of 926 exahashes. Over the coming week, it dipped to 880. It rallied back to 920, and then it has receded over the course of the remainder of April to a local low of 820 exahashes a second, which is a 100 exahash haircut from the all-time high. It's since recovered, but it's still only at 852 exahashes. My biggest question is what's going on with hash rate? Why is all of this hash rate coming offline? This is too much to be normal variance. So there's something bigger going on behind the scenes here, and I would love to have some clarity on that. Don't know who can answer that question for me. But I want to throw it over to Khan, who covers these metrics weekly for Hash Rate Index's Roundup. It's a great read that will help you keep your pulse on all of the most important network data. So Khan, what have you been seeing in some of your recent research?
Thank you, Matt and Colin. You both touched on some points, and I'll add further context to both. Matt, you mentioned the hash price level. We've seen this support level of around $40 per petahash per second per day. To further add context to that, the all-time low hash price currently, the floor that we've seen so far, is in the high 30s. I believe it was around 37. So at that stage, once we get to this sort of trading range for hash price, this is where we start to see significant pressure on a significant portion of online hash rate at the time. So if mining economics were to trend down towards those levels, that's when I would expect to see some significant volatility in network hash rate, Colin, as you just mentioned as well. Another thing you touched on was difficulty. Difficulty, as we know, has been growing relentlessly over the past year and also in closer timeframes as well. I believe something like 12 or 13 out of the past 15 difficulty adjustments have been positive. We are now expecting a negative one, but safe to say, zooming out over the big picture, network difficulty continues to grow. And this is something that I would expect to see going forward. There are a few factors which may change the pace of this trajectory, but generally the direction I expect to continue seeing is for network difficulty to continue increasing.
Yeah, 100%. And I think that if Bitcoin continues to rip, obviously we'll see that trend continue. It does not maybe raise some questions, but people have been calling for a Zeta hash this year. I think we'll still hit that. But a lot of people have tempered their forecasts, both in light of kind of compressed hash price, but also with the tariffs that the Trump administration is levying against basically every trading partner. Right now, they're at 10% flat. We might see them lapse into something more aggressive once the 90-day hiatus for the original tariff schedule comes to pass. But miners get their machines from Asia, Malaysia, or Asia, specifically Thailand, Malaysia, and Indonesia. And all of those are going to have tariffs slapped on them. US-based miners are going to have to pay a premium for those coming in, and that might slow hash rate growth in the beating heart of the Bitcoin network that is the United States. Moving on to our first story. Appreciate all the color there, gents. We have Tether back in the news, as they always seem to stick in headlines. And Tether is eyeing a $25 million stake in Ant Alpha's upcoming IPO. Now, those of you who follow Blockspace know that we covered Ant Alpha's IPO prospectus last week. The Bitmain-tied lending giant wants to go public on the NASDAQ. Now, Ant Alpha provides both Bitcoin-backed loans and ASIC financing loans to Bitcoin miners and other companies, and they would like to be trading on the NASDAQ. We don't know whether or not that will come to fruition this year or later, but Tether is expanding its reach into Ant Alpha, as covered here on Blockspace. According to an SEC filing, it is seeking a $25 million stake in the company, which is seeking a $50 million IPO on the NASDAQ. That is Ant Alpha. So Tether looking to get roughly half or exactly half of the IPO fundraising target for Ant Alpha. They are going to get the same price as any other investor that is offering at the IPO price. And as we covered recently on Blockspace, Tether also recently purchased a really sizable stake in BitDeer. This follows some of their other mining investments, which includes a stake in Northern Data, which I'm not sure if they still hold that stake, but that was one of their original forays into the industry. And I believe Tether also has some operations of their own. Interesting development to see how deep Tether is getting into all of these different aspects of the Bitcoin mining industry. First, they own BitDeer, or most recently they've purchased a sizable stake in BitDeer, so they have a stake in both ASIC manufacturing and hosted mining and pure play mining. Now they're also looking to get their tentacles into one of the premier ASIC financiers, specifically for Asia. I believe last year, Asia accounted for like 77% of Ant Alpha's entire business, whereas the Americas was like roughly 7%. Matt, Con, any thoughts on this one?
Tether, massively profitable, right? They really benefited from a high interest rate environment and the adoption of stablecoins, and they are deploying investments left and right. Interesting tidbit, I guess, is that Bitmain has a strong relationship with Kango, who is accessible on U.S. markets. If Ant Alpha, who also has a strong relationship with Bitmain, is U.S. listed. Those kind of tentacles continue to reach out there. I guess it's an interesting development. But as far as this story goes, I mean, you really covered it. That's all I got on this one.
I would add to that by saying what's interesting to me is the observation of around how other companies that are adjacent to Bitcoin and the Bitcoin mining ecosystem are slowly now coming in towards this industry. We see this with Tether being a great example, a pioneer in the stablecoin business, obviously a massively successful company and highly involved in Bitcoin and Bitcoin mining as well. But we see this in other industries as well. The energy sector is slowly converging towards Bitcoin mining. General AI and high performance computing data centers are also looking into Bitcoin mining as well. And individuals are also interested. Home mining is also seeing a bit of a resurgence as well. All this to say that there's a lot of opportunity for the Bitcoin mining industry to continue to grow. And we see this both internally from incumbents and also from new entrants as well. Tether being an excellent example of a company that's being very forward moving with this.
With Tether deploying all of this cash that they have, they stored the money that they have that collateralizes their stablecoins into treasuries. They made billions of dollars last year in this high interest rate environment. Now that cash is sitting, not producing any yield. Why not invest in some businesses that you think will be winners? TBD what their actual end game is. Maybe it's just, put that capital to use. Maybe they're trying to gain some control over some of these key players in the Bitcoin mining industry, but sure we'll learn more in the months and years to come. On to our next story, Matt. You will be taking the lead on this one. So what is going on with Galaxy's CoreWeave deal? Big news this week.
CoreWeave, probably the most anticipated IPO of the year, continues to be in the news. The former Ethereum miner turned AI HPC company with huge deals with Microsoft and OpenAI has been partnering with Bitcoin mining infrastructure providers, most notably Core Scientific. But now we're seeing a kind of growing partnership with Galaxy. And specifically at their Helios site, which they scooped up from Argo a couple of years ago. So I'll cite a couple of the details here. So it was announced Wednesday that CoreWeave basically secured an additional 260 megawatts from the Helios site. That makes the total contracted capacity with Galaxy at this site to 393 megawatts. And I mean, this site has potential to grow even further, right? I mean, Galaxy noted that they're under various stages of studying the potential for this to be up to 1.7 gigawatts is cited in the story. I mean, we're talking about major energy infrastructure generation and development in the AI space here, and all of it kind of coming from the Bitcoin space. And that Galaxy's really jumped into the deep end as far as transitioning from mining operator to AI HPC development. And I think we're starting to see why with deals like this start to be announced.
I think this is one of the more notable news items for a number of reasons. Number one of the primary concerns from shareholders in Core Scientific's 2024 earnings call and also during the CoreWeave IPO was that both of these companies seem to have intertwined fates at this point. And a lot of investors were saying, CoreWeave's entire business seems to rest on this Bitcoin miner who was bankrupt 2 years ago. So why should we give them money? Why should we expect this to be one of the most coveted stocks of the next few years. And CoreWeave is basically signaling, I think, with this, that they are going to be continuing to put more of their eggs in a different basket, albeit it is a Bitcoin company, right? Galaxy does a lot of things. They're a crypto lender at times. They're a financial services firm. They're also a Bitcoin miner. But this could potentially put to rest some of the unease from people who think that CoreWeave is maybe risking too much by trusting a partner like Core Scientific. And it also shows that they are keen to find opportunities that would maybe be undervalued or are lower barrier to getting their, cloud computing services off the ground. For Galaxy, this is a chance for them to completely de-risk away from Bitcoin mining. And it seems that's kind of where they're going with this. I don't know what their plans will be for the rest of their Bitcoin mining fleet. But as we've seen with Core Scientific, I covered this on a newsletter for Blockworks a few weeks ago on Forward Guidance. Core Scientific has outperformed most of the other Bitcoin miners over the last year or so, and largely just because they have this AI and HPC business line and deal with CoreWeave, right? And as we've seen, these public miners, I wrote about this in the newsletter, they are increasingly becoming less correlated with Bitcoin on the upside. They're still, they still have a higher beta than you would expect something else who's not that's not tied to Bitcoin to have when Bitcoin moves. But on the downside, they have almost the same correlation. And so they are breaking on the upside and not sharing as much in the gains, and they are sharing all on the downside whenever Bitcoin tanks. And we saw that most recently with the sell-off to 70K. So for Galaxy, this is a pretty, if they can pull off the retrofit, this is a pretty smart move to de-risk some of that business, I think, and to decouple from the Bitcoin market on the mining side, but also maybe still share that with all their other crypto services. Con, any thoughts?
Absolutely. Yeah. I have a few thoughts. This is a very interesting development, in my opinion. And the reason is because it's another case which highlights this interesting convergence that we are beginning to see between Bitcoin mining and other forms of high performance computing, AI, generalized computing, both of which are computing commodities, of course. And I think this gives us a glimpse into the future of what computing as a commodity might look like, or how this space might evolve. One very fascinating aspect of this news piece to me is this idea of the hybrid data center, the dual use facility. I think there's going to be a lot of interesting learning and observations that come out of this. Galaxy wrote a great piece, which I would highly recommend for anyone to read who's interested in this concept of how Bitcoin mining interacts with AI and HPC data centers. Clearly, they've done their due diligence. So has the rest of the industry. And what we've learned from this so far is that some miners, depending on their profile, can be highly attractive for this type of data center space because they have high quality assets, specifically power assets. And that's what these AI HPC data centers tend to want or need as well. There's a whole host of other factors which plays into this decision. But it's clear that some miners are able to win and provide value from this. Now, on the other side, a recent Blockspace episode with Christian Lopez from Cohen and Capital Markets had really good insights about the capital markets aspect of this and how deals are done as well. It's highly accretive for Bitcoin mining companies to look into these opportunities because the general data center industry tends to trade at more favorable multiples. So from that perspective, from a miner's perspective, like you mentioned, there's opportunities for them to increase shareholder value, either through M&A deals that are accretive or through de-risking their operations and diversifying their revenue streams. At the same time, AI and HPC data centers might find Bitcoin miners to be interesting because it allows them to become a flexible load center, which might make it easier for them to get access to power in the long run, cheaper and also more accessible. So I think this overall big picture trend is going to be a very interesting observation for us to continue monitoring over time.
Miners, are you ready to earn more with what you already have? That's what Fractal Bitcoin is for, scaling Bitcoin with Bitcoin using a fully compatible recursive design. In just 7 months, Fractal's hit 18 million users and nearly 2 billion transactions. Fractal's cadence mining reduces up to 50% of your pool fee, No new hardware, no extra energy, and it's easy. FB rewards go straight to your existing Bitcoin wallet address. Over 90% of Bitcoin's hash power is already merge mining Fractal. Get more from the same resources. Start on Fractal today.
The impact of the halving 1 year on, we were really happy to have this article because it's always helpful to look back a year after an event like the halving, and you really contextualize some of the biggest changes to the Bitcoin mining network on the data side with this article. So let's just kind of take it away. What have we seen, Con, 1 year after the halving with regards to Bitcoin difficulty, hash rate, and transaction fees?
Absolutely. Yeah. Let's take a look into it. So if I were to summarize this whole article in one single sentence, it would be this. Since the halving, miners have faced a challenging trifecta. The 50% revenue cut, relentless growth in network difficulty, and historically low transaction fee rewards, as mentioned throughout this episode. Rising competition, revenue uncertainty. What this means is that mining margins have been compressed since the halving, which of course reflects in hash price. We touched on hash price earlier in this episode. It's the mining metric, which quantifies how much revenue a miner can earn. And we know that hash price is positively associated with changes to Bitcoin price and fee volume, but negatively associated with changes to network difficulty. So let's take a look at some of these factors, some of these constituents which play into hash price. First thing, let's talk a little bit about Bitcoin price and network difficulty. Between April 2023 and April 2025, so this is a time frame that looks at the 12 months before the halving and the 12 months after the halving, Bitcoin's daily price more than tripled. It averaged 57,500. This seems low, but remember, this is a 2-year time frame that we're looking at. The point is, this is bullish momentum, but it was met with an equally aggressive rise in network difficulty. These two forces grappled with each other, and ultimately, difficulty came out on top, which we see through hash price declining. Difficulty at the time of the halving was 86.39 trillion, which roughly equates to around 620 exahashes per second. So this is April 2024. A year later, currently, we're at an all-time high of 123.23 trillion, which roughly equates to 880 exahashes per second. So that's over a 40% increase over the past year that we've seen in difficulty. At the same time, fees. One surprising development is we've seen a sharp decline in transaction fee volume. Between April 23 and April 25, again, 2-year time frame, average transaction fee collection fell by 70% from 0.550 Bitcoin to 0.165 Bitcoin. And this metric is per block per day. Another way we can look at transaction fees is by observing the fees as a share of total block rewards. Pre-halving, this averaged 7%, just over 7%, 7.1, and post-halving that fell to just around 4%. All in all, basically, we've seen isolated fee spikes here and there from alternative on-chain activity, but still the reduced fee market environment has only challenged miner revenues instead of supporting it.
This is one of my favorite charts from this whole thing because it really shows how much of a difference fees can make for miner bottom lines. Just looking at that pre-halving average in 2023 and in 2024, when ordinals activity was at its peak, at 7%, that's meaningful revenue for a miner, right? And then if you even look at like the 5.6% for the last 2 years, April 2023 to April 2025, also meaningful. And the 4% that we have for the post-halving doesn't seem like that big of a drop-off, but I think it's also important to contextualize that the majority of that 4% is weighted for the period right after the halving when runes were still being traded. So it's kind of shows a biased view because transaction fees were going crazy right after the halving with some runes trading, which is an inscriptions token standard, and other inscriptions while they were still hot. But since then, transaction fees have been dead. We had, I think a few weeks ago, we had an empty block that wasn't just mined empty. Like it wasn't just an empty block mined on purpose. There were no transactions in the miner's mempool. And we've had fees bouncing between 1% and 2% of total block rewards. So anyway, I just wanted to add that context.
Absolutely. Yeah, and to bring all this together, what does this mean for hash price? We have the increase in difficulty, we have low fees. This overwhelmed hash price despite the positive Bitcoin price action that we've seen. And what this means is that Bitcoin hash price declined. So USD hash price averaged $66.35 per petahash per second per day between April 2023 and April 2025. Currently, we talked about it, we're just around the $50 mark. We take a look at Bitcoin denominated hash price, though. It's seen a significant decrease. Pre-halving, Bitcoin denominated hash price for the 2 years averaged around 145,000 Satoshis per petahash per second per day. Right now, we're at just around 51,000 Satoshis per petahash per second per day. So that is a significant decrease, around a 70-80% decrease.
Yeah, getting eroded even more by difficulty as well as halved by the halving.
Exactly.
And for that BTC per petahash per day, Con, there's some interesting insights here from Luxor's forward market that I'd love to highlight as well. In the TLDR, and you can explain why here in a second, is that the miners and traders who are trading BTC denominated hash rate contracts, and for those who don't know, Luxor's forward market allows miners and traders to basically sell forward or buy forward Bitcoin mining production at a set price. So it's a way to either go long or short hash rate. And the BTC forward contracts outperform spot hash price, but we didn't see that on the USD side. Do you have any context for that, Con, or any color you can add?
Absolutely, yeah. This is my favorite aspect of the Bitcoin mining industry because it tells us so much. There's so much information and insights that we can learn from observing the forward hash rate market, just like you mentioned, Colin. So this market, it enables miners to hedge and to reduce exposure to hash price. So everything that we just talked about, it enables miners to control and manage this risk. Historically, revenues have always been sensitive to hash price, and this makes it difficult for operators to forecast cash flows or to secure financing. What the forward market is really telling us is expectations versus reality. So, Colin, to come back to your point, is if we see one market outperforming relative to another, it means that there's a misalignment between what market participants thought would happen to hash price and what really happened. And we'll take a look at what the story was here. So following the halving, mining market participants in the forward market were met with surprise. Difficulty consistently outpaced expectations, while transaction fees fell short. These headwinds together compressed mining margins. But what it means is that actual Bitcoin-denominated hash price was consistently lower than what forward market participants expected, as you can see in this chart. The solid line is the real settlement of hash price as measured by Luxor's hash price index. And the dashed lines show what the forward market expected during each month. And we can see that expectations are above actual settlements. Now, conversely, in the USD denominated market, we see the exact opposite. And the reason was because there was significant Bitcoin price volatility since the halving, right? We had the post-election rally. And since then, starting in 2025, we've had developments in the geopolitical and macroeconomic world, which have affected US dollar denominated hash price. And that's what we're seeing in this chart here. The post-election rally caused actual hash price to exceed what forward market participants thought hash price would be at. Bringing all this together, what this means is that the Bitcoin market overshot and the USD market undershot. And this misalignment is exactly where the opportunity lies, is because this information, this misalignment, is what the market is trading. The optimal strategy here was, in fact, to lock in fixed Bitcoin denominated payments by selling forward in the Bitcoin denominated market. This would allow a miner to essentially lock in a hash price throughout that term.
Yeah, it seems like if you wanted to play it safe, do the BTC denominated. If you wanted to play the tables, go for USD. It makes sense, right? There are more variables with the USD denominated hash price. Thank you, Con. Appreciate the insights there. I want to hop over to Cambridge's report really quickly, and then we will end quickly on a cry corner with the op return drama. So a few notes on this Cambridge report. For those of you who don't know, Cambridge has been tracking Bitcoin mining data for quite some time. They have an electricity consumption index, and they take survey data from a bunch of different Bitcoin companies to create some of these reports that try to give insight into the more hidden metrics in Bitcoin mining, right? We just covered all the ones that are out in the open, but others such as electricity consumption, average efficiency on the network, hash rate distribution around the world are much more hidden. And one of the findings from the report that gives a more recent update on Bitcoin's electricity consumption from their older ones is that they estimate that the annual electricity consumption of Bitcoin in 2024 has expanded by 17% to 138 terawatts hours on average, representing about 0.5% of Bitcoin's total, or of the world's total electricity consumption. And this was, let me amend that, this was from June 2023 to 2024, I believe, was the annual growth there, because this data is recent as of June 2024. They also estimate that electricity accounts for over 80% of miners' cash-based operational expenses, with reported median cost of $45 per megawatt hour and $55.50 per megawatt hour all in. Another thing that the report found, and this is the thing that I will kind of pick a bone with, is that it estimates that roughly, let's see, I have the number here in notes, more than 50% of Bitcoin mining's energy mix comes from sustainable sources. Now, to contextualize this, what you have to understand is that this report is based on survey data from a bunch of different Bitcoin mining companies that you can find in the notes for methodology. But most of these companies are US listed companies or US based companies. So I think we get a skewed representation. The 50% renewable penetration could very well be accurate, but I'm looking at this global distribution of mining activity, and it kind of calls into question whether or not that data is clean, because it says the top 5 companies based on reported mining activity, 75% from the US, 7% from Canada, 3% from Paraguay, 3% from Norway, and 2.7 or 2.6% from Kazakhstan. Now, to be fair to them, they do caveat saying this is just based on the reported data, but that kind of gives the idea that the United States is number 1, as we know, Canada is number 2, when in fact we know that Russia and China actually have quite a lot of Bitcoin mining activity. Without insights into those regions, it's really hard to trust 100% some of the data that they present here. They're not getting surveys from those companies. Any thoughts, fellows?
Yeah, so it's like you read my mind. It's very interesting data. I think it's about as good as you could do, and I think they deserve a lot of credit. But of course, we know that there is a lot of mining in China and Russia, and that it's a bit of a black box, right? And so you have to take this with a little bit of a grain of salt. We know that renewables do make a lot of sense for Bitcoin miners, in the sense that they tend to be cheap, right? And miners are not ideologically driven, right? They are mercenaries. They are companies that are trying to drive higher earnings and be as profitable as possible. So they're going to seek out stranded, wasted forms of energy. And this has been consistent over time. And so they have it improved a carbon intensity rating compared to other energy intensive industries, if you will. I think this report does a great job of kind of highlighting that. I think it gives a lot of insight into the U.S. Mining scene. But one last thing, right? You talked about the increase in electricity usage, right? I think you said it's 17%. You think about how much hash rate has ripped, in the last year, just goes to show the deployment of more efficient hardware machines, right? That's, I think, kind of something that maybe isn't catching as much press, but those that are in mining circles, know well. But yeah, great report. Think they get a lot of credit, but you definitely have to look at the numbers and kind of think of them as generalized and directional rather than absolute, because of some of the skew towards North America.
My points here, both made great points. I think the Cambridge report is a great update, well needed as well, both for the industry and both for the institution as well. Previously, they had their website, which had good data, but it was relatively stale. So now we have an updated view into their observations, which is excellent. This is a significant contribution to the industry in terms of research and high quality information, because it allows market participants, both internal and external, to further triangulate and come up with better estimates. Matt, like you said, there's no way for us to know exactly what the hash rate is or what the global distribution of it is, or exactly what the average cost or efficiency of the network is as well. But we can make estimates, and as more entities make more estimates, eventually we can triangulate and come to a roundabout neighborhood of an educated guesstimate. So that's the best we can do with these sorts of observations, and I think it's getting better. Another interesting observation to note is this narrative around electricity consumption and environmentalism, etc. I think it's safe to say at this stage that the level and quality of information around this concept is just simply much better. And we're starting to see perceptions change around this, not only from industry, from the private sector, but also from the public sector as well.
Well said, gents. All right. We're running a little bit over, but let's go ahead and hop over to this week's Cry Corner, which is a series of tweets on the op return drama. So quick update for those who don't know. Bitcoin developer Peter Todd created a request on GitHub recently to remove Bitcoin's op return limit. So an op return is a field in Bitcoin transactions that allows you to submit arbitrary data. Famously, Satoshi used it to provide the headline for the front page of the Times in the UK at the time when he published the first block, or when he mined the first block of Bitcoin. That's the chancellor on brink of bailout, of second bailout for banks. Right now, the op return limit is 80 bytes. Peter Todd wants to get rid of it entirely so that we can use that for things such as zero knowledge proofs, ZK rollups, a form of L2 on Bitcoin, and other data uses that we could use to leverage layer 2 technologies or things built on top of Bitcoin. A lot of people really don't like this. And the reason they don't like this is because op returns are used for things in the inscriptions and ordinals landscape. This creates spam on chain, as the Luke Dash Juniors of the world like to argue, and is even akin to sexual assault. That is straight from the horse's mouth from Luke Dash Jr. He is not joking about that. This kind of weird postmodern semantics game that he likes to play, saying that this is a violation of your sacred right to block space. And this has been one of the more contentious issues I've seen from Bitcoiners in a long time. It's kind of an extension of the fighting over inscriptions, whether or not you think Bitcoin is for everyone and anyone can put data as long as it meets consensus rules, or if you are a monetary maximalist and think it should be used for only economic transactions. But all that being said, the reason why I wanted to choose this for the Cry Corner, not just because there are some ridiculous tweets and also some great ones from BitPain, like how dare you use op return data for gasp arbitrary data, citing the op return from Satoshi's Genesis block. But the fact of the matter is that the crux of this is whether or not we should allow for arbitrary data onto Bitcoin. And one of the arguments is that you should try to restrict this as much as possible. You should try to filter it, especially in the case of inscriptions. And I'm here to tell you from miners that I've talked to with services like Slipstream, built by Mara, which allows miners to submit data directly to mining pool nodes. This data is going to get into Bitcoin, whether you like it or not. And you are creating two separate mempools if you try to filter this. This is my personal opinion, and opening up the chance for increased out-of-band payments directly to mining pools as they send in their transactions rather than relaying them through the global mempool, bouncing from node to node until they get to a miner's node. This creates potential fee estimation problems because you don't actually know what fees are being paid on those out-of-band rails. And it honestly just fragments the network, and I don't really see any point in it. That's my spiel. Your thoughts, gentlemen?
I think the heart of this debate is actually about policy and consensus rule in Bitcoin Core. But this is a mining show, so I want to center the conversation about mining and what view you have of the mempool and what your estimates of fees are very important to you as a miner, and in constructing, in pools in particular, right, in constructing block templates. And those are some nuanced words that we could do an entire show on. But, I think the thing about Bitcoin is that it has a high resistance to censorship. And the reason it has a high resistance to censorship is because if there are transactions that offer economical fees, someone will be willing to stick their neck out and include that transaction in the chain because they're incentivized economically. That has been the case in Bitcoin. I think it will always be the case in Bitcoin. And miners are the true benefactors of that, right? Miners that are willing to include transactions with higher fees than their peers have a competitive advantage. I would love to do an entire show on this, but we don't have the time. So I'll throw it out to Con for his closing thoughts.
Yeah, super interesting developments. Like Matt mentioned, yeah, this is a mining specific show, so I'll keep my comments to mining only as well. I think from a mining perspective, this definitely has an influence on mining economics, like you mentioned, Colin. So it's important to stay up to date with this sort of information. It's an ongoing debates within the network, and it goes to show how the governance system of Bitcoin works internally. This is an interesting case of an ongoing development within the Bitcoin network. Usually we're used to talking about factors that influence Bitcoin externally, for example, things like macroeconomics, geopolitics, etc. But this is intrinsic to the Bitcoin network itself. This is its governance model in action, real time. This is open source software developments being discussed in real time. And it's somewhat messy and it can be slow and clunky, but that's also what makes the Bitcoin network resilient. So yeah, I'm curious to see what sort of developments will come out of this. But safe to say, as a mining analyst, all I'm doing is just observing, how this might affect hash price and mining economics.
100%. Well, Con, thank you so much for joining, man. And for everyone who's tuning in, we appreciate you. Please like and subscribe to this video if you're watching on YouTube, and check out all of our mining pods at blockspace.media or on Spotify, Apple, and wherever you get your podcasts. Appreciate y'all. Have a good week and a great weekend, and we'll see y'all next week.